So Ashwin, how do you define the risk and return for Axis Equity Saver?
If you look at the potential risk return of a product like this, you have to look at what the asset allocation is like, especially the directional equity component. In this case, the directional equity component goes to a maximum of 45%. That drives the risk of this product. So if you compare it to, let's say, an MIP versus a balanced category, typical MIP funds have a much lower directional equity exposure. Typical balanced funds in the market have a much higher directional equity exposure. So we think that from a risk return profile, this fund will sit somewhere in the middle of your MIP funds versus the balanced funds in the market. If you look at the equity saver strategy and compare it to single asset performance on a 2-year rolling basis, the observation is that as you would expect, equity returns are highly volatile. You see huge ups and downs from period to period. Likewise, there is a certain amount of volatility in bonds as well. In a model portfolio where you look at a combination of equity, bonds and liquid fund index, so you get a fair amount of stability as far as risk return performance is concerned on a 2-year rolling basis. If you look at 3-year rolling periods then and draw the range of returns and also compare the averages across 3-year rolling periods, then what you find once again is that the range of returns for equities can be very wide with a substantial amount of potential downside even from a 3-year rolling perspective. Likewise, the range for bonds and liquid fund is lower. However, their average returns is quite lower compared to what the equity returns are like. If you look at the multi-asset model portfolio on the other hand, you get a bit of a benefit of that multi-asset approach where the average returns can get a bit better, but the range of outcomes on a 3-year rolling basis are much narrower compared to the wide range of outcomes that we see for pure equity allocations. So here it reiterates the benefit of multi-asset approach. In a multi-asset diversification approach, you allocate across not just one asset class but across equity, bonds and hedged equity, and the multi-asset approach allows you to run a much lower risk profile compared to pure equity approach and gives you a much more optimal risk return profile, especially for conservative investors as opposed to a pure equity product can.
So as I understand, Ashwin, Axis Equity Saver optimizes the risk and return and it brings down volatility as against single asset like equity for the client.
Yeah, that's right.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.